Hello and welcome back. We are going to be talking a little bit today about the stock market, the end of the 1920s, what the economy was doing in the 1920s that's going to lead us into the Great Depression. So, we've kind of already talked about this, but following World War I, we had a really slow kind of downturn or recession where the economy isn't doing so great. But then all of a sudden, the economy is doing really great. It's booming. Lots of money's coming into the U.S. And so, because there's more money coming in, that leads to more factories, more jobs, more money. So, people have more money to spend. They have more what they call disposable income. Disposable income means money that doesn't have to go towards like food or rent. So, it's kind of, you might think of it as like your spending money or your play money. And there's just more jobs, which means more people have more money. So, really, the economy, or how much money people have, was doing really well in the 1920s. Now, there's another thing that kind of started in the 1920s, and what it was really this idea of being able to easily get credit. So when you're thinking about credit, for modern day society, that means like credit cards. Today's world, it means loans. Back in the 1920s, they didn't have credit cards yet, but they did have loans. Before this time, most people didn't really go out and get a lot of credit. They didn't get a lot of loans. You had to pay cash for stuff. If you didn't have cash for it, you couldn't get it. But beginning in the late teens and the early 1920s, we started to see where people could get credit, and it was actually really easy to get credit. Like, you might not have to have a lot of money, or maybe you didn't have anything that was gonna, if you didn't pay it, they were gonna take away something. And so they came up with these, what they called installment plans, and that basically meant you were going to pay so much each month or so much each week towards paying off whatever your loan was. And then they also, once again, had this buying on credit. So you could go out and buy these things that you didn't have money for. Just kind of like a lot of people today go out and buy using credit cards. Now, here's the bad points of this really easy credit. First off, there wasn't regulation. And regulation means that the government watches over to make sure that everything is fair and that everything is okay. It's on the up and up. And there wasn't any regulation. There was no one really watching it to make sure that someone wasn't trying to take advantage of people or that people really could pay back that money. The people who were the people who were getting the money, who were taking out these loans and buying stuff on credit, they really didn't understand that, if something could happen and you all of a sudden couldn't pay this and you could lose everything. And I know it might be a little difficult for us to understand because you guys have grown up in a world that there's credit. But these people didn't. Like, they didn't understand it was this new thing. And so they didn't understand that something could happen and you would no longer be able to pay for that. And that meant you were going to lose your house or your farm, or you were going to lose everything. The other big problem with this whole easy credit thing was that because people were just buying stuff when they couldn't afford it, it kind of hid some problems that were actually in the economy. So while it looked like the economy was booming in the 1920s, really it wasn't doing as well as all of that. But because people were buying stuff that they couldn't afford, it kind of hid that. You couldn't see that they didn't have money. So now we're going to talk about the stock market. So what the stock market is you take a corporation, and what they do is they basically break up ownership into little pieces. And when you buy a stock, you're buying a piece of that company. And so the stock market is where you sell those pieces or those stocks. Well, the 1920s had what we called a bull market. That meant it was up. It was doing really well. And because it was doing so well, a lot of Americans are going to invest in the stock market. And actually what started to happen was, instead of people putting money in their savings accounts or in the bank, they started buying stocks. Now you might be asking yourself, why would they not put it into savings? If they didn't have money and they're buying all this stuff on credit, why wouldn't they take what little money they have and put it in savings? Well, just think about, if you have a savings account, how much money do you really get back on that? Maybe a penny or two? You don't get a lot. But it's important. We know savings accounts are important to have, because if something happens, we want to have that money there. Well, in the 1920s, they were like, why am I going to put this money in a bank when I can invest it in stocks and I can make a ton of money really quickly? And a lot of this goes to the point that they really didn't understand that you could lose money in the stock market. If that company or that corporation that you bought a piece of all of a sudden doesn't do so well, or their stock drops, it means people don't want to pay a lot of money to own part of it, you're going to lose money. Because if you paid $500 for a stock and all of a sudden now that's only worth $100, you just lost $400. And they just really didn't understand that. So here is our question. Why did people buy stocks instead of putting it in savings at the bank? A, they thought it would make them more money. Or B, they thought it was safer. So now we've kind of looked at what the economy was doing in the 1920s. We talked about the stock market, how people were buying things on credit. So we're going to start to see problems coming up very quickly. The first area we're going to see some problems is with agriculture or farms. Remember we said that during World War I, the United States is in the war and they're having to send all of these supplies and troops and food over to Europe. And after the war, they were still having to send a lot of food over to Europe because the country was so devastated from all of the war. Well, what started to happen really quickly was that Europe didn't need that anymore, and farmers could no longer sell off all of these crops that they were having. And so farmers were stuck with a bunch of crops that they couldn't sell. And so they started losing money. They were producing way too much food, and it wasn't selling. Also, another big problem that's going to happen is that farmers start to put more and more land into crops. By that, I mean that they start to take up areas that were not made normally for, or had not been used for farming before, and now they're turning that into farmland. This is especially going to happen in the Great Plains. When you're thinking the Great Plains, if you've ever visited like North Dakota, South Dakota, the western part of Montana, down through like Nebraska, those kind of areas, you might have seen these Great Plains, and it's really flat, it's windy, and they started to take that land and put it into crops. But the thing is that they didn't understand that those crops weren't made for that soil. And what I mean by that is that they were starting to plant a lot of like corn and grain. And those roots for those plants are different than the natural plants on the plains. The natural grasses that are on the plains, the grasses that grow there wild, are actually very deep-rooted and widespread. So what they do is they hold down the topsoil, those top layers of dirt. They hold it down so that when the wind comes through, the dirt stays. Well, when they began to use this and they were plowing it and they were planting corn and grain, those crops do not hold down the soil. And what started to happen was you started to see all of this soil being carried away in these huge windstorms. The third big problem that we see with farmers is that there were huge droughts that were going on. And it kind of depended on the area, but throughout the Great Plains, we saw these huge droughts that were starting way back in the early 1900s through the teens and especially into the 1920s and 30s. Huge drought years. There will be some areas in Montana, for example, that will have like a decade of drought years. There's not enough rain. There's not enough water. So if you take that, you take all this drought and you add to it that they're not having these natural grasses to hold down the soil, and you're planting crops that need more rain that were not made for that area, you're going to start to see some huge problems with the environment. Farmers began to buy more and more equipment so that they could produce more food. Remember, we talked about all those technological advances in the 1920s? And so farmers believed that in order to keep up, they had to buy this newest equipment. Well, they couldn't afford it, so what did they do? They bought it on credit. And what happened was that farmers started living month to month on credit because they weren't selling their crops, or in some cases because of the droughts they didn't have crops, and then they had these huge bills. And so farmers started to lose their farms. You're looking at a picture right now. This is in Montana, and you can see how barren and desolate it is. This is from all the drought years. And so farms very quickly started to go under in the 1920s and especially in the 1930s. Another huge problem that we see in the 1920s is that the rich become richer and the workers become poorer. Those who have the money are making more and more and more money, and those who don't have money are getting less and less. So what we call the difference between the rich and the poor was extremely high. This is going to lead, we were talking about the stock market, people buying all these stocks when they didn't have any money, and we're going to start to see this affect the stock market. By 1929, people were buying more and more stocks. Like they were just purchasing stocks all over. The problem is that the prices of the stocks weren't actually based off of whether the company was a good company or the company was going to make money. It was just based on this idea, literally, people would buy stocks because they're like, ooh, that's a cheap stock, I'm going to buy it, and then I'll sell it tomorrow and make more money. Ooh, that looks like a stock I'll buy. So the prices for these companies would go up, and that really didn't mean anything. It didn't mean it was a good company or that company was going to make money or someone else was going to want to buy your stock later. It just meant that someone was selling it. People also started buying stocks on what's called the margin. What this would mean was basically you would go out and buy this stock or this piece of this company. You'd want to buy it, so you would go to the person and you'd say, hey, I see you're selling it for $100. I will buy that from you. I can't pay you for it today, but I'll give you $300 when I sell it next week. And that's what we do. Now, okay, you're like, well, I could see that, like they'll make money. What happens though if the price of that stock drops? What happens if something bad happens to that business and it's no longer there? Or people realize they don't want that business anymore and that stock that was worth $100 is now worth $25 and you have to pay that person $300. So you've not only lost money in your stock, you're now owing even more money that you don't have. So all of these things are playing in with the stock market, people buying these stocks like crazy, not really investigating them, not making sure that they're worth the money. And on October 29th, 1929, the market crashed. And by crashing, what I mean is that on that day, people started selling stocks. It had happened a little bit earlier in the week before. We started seeing stock prices dropping, and then it kind of made a little bit of a rise. People bought a little bit again, and then all of a sudden people started selling, And basically what happened was like mass hysteria, and people were like, oh my gosh, they're selling, I better sell. Oh my goodness, look, they're selling, I better sell. And everybody started selling, and they were just selling, and no one was buying, and the market just bottomed out. So you're looking at this is kind of what I was talking about. So you can see how the stock market, like, look at, I mean, in the 1929, how many stocks people are like, I mean, they're buying like crazy. And it gets way up here. And then, like I said, we saw this little bit of a dip where people kind of started to sell, maybe thinking that the stocks weren't worth as much. And we saw a little bit of a rise right here. And then this is Black Tuesday. People just start selling. And this is one day what happens to the stock market. We can see that it's going to kind of come up again, and then it just crashes all the way down. And then it just keeps through here while we're in the Great Depression. So this is known as Black Tuesday because that's the day. Now you might say, well, why didn't someone just stop it? Why didn't they just be like, hey, let's not, no panicking, we'll stop. Remember, there wasn't regulations. Today, if the stock market starts to plunge like that, the government will actually step in and shut down Wall Street. And it's called Wall Street because that's the street it's on. It's a building on Wall Street in New York City. But basically, for example, following 9/11, they actually shut down Wall Street for 2 days to make sure that people didn't panic. But in the 1920s, they didn't have that. So our question, what is the name of the day the stock market crashed on October 29th of 1929? Is it A, Black Thursday, or B, Black Tuesday? Now this is just a graphic. It might help you to take a picture of this or take a screenshot, but what this is showing you is some of the things that lead into this stock market crash of 1929. So we talked about buying on credit, speculation. That means where you think something is going to go up in price when it's not. People panicking, people don't understand their finances, they don't understand credit. Then people start losing confidence in the economy. People just buying and buying and buying. People selling and selling, and no regulation. If we talk about why the market's going to crash in 1929, it is all of these reasons are going to play into this. So let's watch a short video covering this.
Most people mark the beginning of the Great Depression with a day known as Black Tuesday. What happened on Black Tuesday? Why is that day so important? A corporation is a business which individuals buy stock in. The more stock one owns, the larger share of the corporation that person has. These stocks are bought, sold, and traded on the stock exchange. The American Stock Exchange is located on Wall Street in New York City. The success and failure of these corporations is gauged by the Dow Jones Industrial Average. The Dow Jones is an index which shows how large corporations are performing on the stock exchange. If the Dow Jones average goes up, this means that corporations are prosperous and their shareholders are making money. If the Dow Jones average goes down, this means that many of the corporations are facing economic hardships. Throughout the 1920s, the Dow Jones Industrial Average had steadily gone up, along with the unprecedented economic growth in the United States. In fact, it had continued to rise for 9 years in a row. However, in 1929, the stock market saw major fluctuations. Throughout the year, there were ups and downs as investors bought and sold in sporadic fashion. During the summer months, some economic analysts predicted a major slump, but most did not heed this warning. Thursday, October the 24th, 1929, was the first day that saw a dramatic shift. When the stock exchange on Wall Street opened, there was heavy trading, with many choosing to sell their stocks and get out of the market. This caused an 11% drop in the value of the market. A group of leading bankers even held a meeting to see if they might be able to find a solution to the panic that had ensued on that day. Monday, October 28th, saw even more activity. The Dow Jones Industrial Average spiraled further downward. This meant that many investors desired to sell their stock, but no one wanted to purchase those stocks for the prices that they were being sold at. The next day, October the 29th, 1929, was the day that will forever be remembered as Black Tuesday. That day, the Dow Jones Industrial Average fell 30 points, losing 12% of its value. More than 16 million shares were traded, a record that would stand for more than 40 years. With so many investors looking to dump their stocks, hysteria ensued, and thousands of people lost their personal fortunes. The stock market had lost more than $30 billion in value over the course of 2 days, and the event became known as the stock market crash. The stock market continued to fall even lower over the next 2 weeks before finally stabilizing in mid-November. June of 1930 saw another slump in the market, and yet another downward spiral occurred in April of 1931. Investors had lost faith in the American economy. The decline in stock prices caused bankruptcy and business closures for many corporations. Expansion and innovation became more difficult as no one wanted to invest their financial capital and take risks. As a result, it would take more than a decade